Mira Business FM, where business comes to talk.
This is Mira Business FM, and it's another edition of our weekly legal show and podcast, The Fine Print. This time, new tax rules in the UAE now in effect as of this month, and they bring updated refund deadlines and also extended audit windows that businesses really do need to be aware of. Now, while the changes they're kind of technical in nature, they could have real implications for compliance, for cash flow, and also risk exposure as well. So what this means in practice is not something I can do in detail, but my guest can, because he understands this stuff far better than I. Legal expert Raymond Kisswany, he's a partner at Davidson Co, back with us. Good to see you, Raymond.
Very good to be back. How are you?
Good to have you here. I'm all right, thank you. I need to get to grips with this. Tax is an area I'll be honest with you. Tax, people say the word, and I have there's a feeling of fear that enters my body. Am I unique?
No, because I have the same sense of fear and also extreme drowsiness whenever tax comes up.
I know it's very difficult. It's not a sexy topic, but the point with this is it's very important. Obviously, particularly important because this is kind of an update for CFOs. Really, the era of passive tax management is kind of officially over. So let's start with an overview. The key tax rule changes that have come into effect, because this is right now, it's this month.
Yeah, I mean, the key point is that these kind of April changes aren't happening in a vacuum or in isolation. They're sitting on top of amendments that came in from the tax procedures law that came into effect at the beginning of this year. Yeah. And so in practical terms, we can kind of split it into four different changes that business have to keep an eye out. So the first would be that there is now a much clearer framework for refunds of tax balances. Taxpayers generally have up to 5 years from the end of the relevant tax period to submit a refund claim or use that credit balance to settle their existing tax liabilities. If they miss that deadline of 5 years, then the right to claim that refund lapses effectively.
Right.
So, and the second is that these rule changes now expressly confirm that refund procedures apply to any credit in favor of the taxpayer rather than the opposite. So that's becoming a very clear point now.
Okay.
The third is that there's an extension of record keeping and audit related time exposures for certain refund scenarios. If a refund application is submitted close to the end of the limitation period, the federal tax authority can still audit or assess beyond the usual 5-year window, provided it does so within a specific additional period. The law is now expressly allowing the FTA to complete that process within 2 years from the date of the refund application in those cases. And sort of lastly, the amended framework also tightens up the rules around voluntary disclosures and around confidential the tax information.
Right.
So the overall direction is greater procedural clarity, but with also more formal oversight by the FTA.
Okay, so let's look at a few of the points in more detail. This is from April the 1st. Gladly not an April Fool, but
close enough.
There were a few this year. What's happened is the ability to carry forward tax credits indefinitely is gone. Right? So that means if you don't claim your refund within 5 years, it vanishes. And that was kind of a housekeeping move in a way by the Ministry of Finance. But it also means, doesn't it, it's strategic as well, because it gets liquidity moving back in to the private sector. That's important.
Yeah, exactly.
Yeah. All right, though. So there is a transitional window closing at the end of this year. I think it's New Year's Eve 2026, I believe, for those with long-standing balances. How do the new refund deadlines impact businesses what do you anticipate from your clients on a day-to-day basis?
Yeah, I think that this matters a great deal from a day-to-day level, because tax credits are not just a simple accounting issue. They, as you rightly said, they actually do affect cash flow, working capital, and the kind of internal planning of a business. In the past, some companies were comfortable leaving credit balances sitting on the system for long periods of time.
Right.
Under these amended rules, that kind of practice is going to become much riskier. The law now imposes that defined time limit of 5 years from the end of the relevant tax period to be able to claim your refund or to use it against your existing liabilities. So if you don't make the claim within that time period, you've effectively lost that right to a refund. What that translates to, what that means is that finance teams can no longer treat old balances as something that they have to tidy up later on, right? They need to identify what those balances are, what they relate to, confirm whether they arose from an overpayment or a return or a voluntary disclosure or from an FTA decision, whatever it may be, and then be able to apply the deadline carefully to it.
Right.
The law is providing some flexibility where the credit balance arises after the 5-year period, or in the last 90 days of it, but it still requires active monitoring and sort of taking a proactive step, right? So there is also kind of an important transitional rule. Taxpayers whose 5-year period had already expired before the 1st of January of this year, or would expire within 1 year from that date, they were given a 1-year window from the 1st of January to submit refund requests. There's also been some reporting that businesses with long-standing credit balances that were effective until the 31st of December can claim refunds and offset in that transitional period. So in sort of real business terms, the daily impact is that finance teams should be reviewing their business ledgers now, not later. Making sure that old credit balances are reconciled, documented, and either used or claimed within this period. Otherwise, you're seriously going to be effectively leaving money on the table.
You're going to lose it, aren't you? Okay. If you're sitting on tax credits. Another thing, while we're on this kind of timeline aspect of this, is that audit windows have been extended. So it used to be talk was of a 5-year limit, right? Now, in cases of tax evasion or maybe failure to register, for example, the FTA can look back 15 years, I read. So I suppose for want of a better term, high risk cases, the books are never really closed, or certainly open for 3 times as long.
Yeah, exactly. It does sort of change the audit window as to what it means in practical terms, because ordinarily the FTA cannot conduct tax audit or issue tax assessments after 5 years from the end of a relevant tax period.
Yes.
But one of those exceptions now clearly applies where a refund application is submitted during the 5th year,
right,
or within a certain extended period of time. In those cases, the FTA can still audit or assess, provided it completes the process within 2 years from the date of the refund application. So practically speaking, a business should not assume that once it approaches the end of that 5-year limitation period, the file is effectively closed. A refund claim can effectively reopen or restart the scrutiny timeline, and that has some practical consequences to it. I mean, first, you can have businesses tend to keep their supporting documents. They will be required to keep it for a longer period of time now. The refund claims should be treated as an audit triggering event rather than just an application for a refund. And I think it also kind of affects the transaction hygiene, if you will. If a company is making a refund claim in 2026 relating to much older tax periods, it needs to ensure the people, the records, the data, the invoices, all of these things can defend that claim and are still available and are organized.
That's important to know. What else have we got? There's an awful lot here, and I'm trying to be methodical, but I'm going to jump about because retaining the information is hard when it comes to tax. Obviously, the law now requires that businesses keep documents for an additional 2 years, as you say, if a refund claim is pending near the expiry date. If you're an SME and you've got limited storage, digital storage, or physical filing area, that's an administrative burden, isn't it? Because that kind of extended preservation creates, you've got to be able to prove this. You need to think ahead and think, we do need additional storage, whether it's digital or not.
Yeah, I mean, it's quite difficult, and especially on those SMEs because they are going to be triggering those tax filings. But as you say, sort of, it's about resource spend. And,
It is, yeah.
And what do you do? So, I mean, I think that there's some practical things that especially SMEs can prioritize. I think a good first step would be to review whether you have any old tax credit balances and determine the deadlines for claiming or using those. That's urgent because again, if you miss that deadline, you effectively have left the money on the table. Another thing that they can do is try to gather and centralize the supporting documents for those balances now, and not wait until the FTA queries that down the line effectively.
Okay.
The third is check whether the accounting team or the external provider has a clear process for tracking refund applications and keeping up with limitation dates, because there are a lot of SMEs that will use an external provider to deal with their accounting and their tax recording. And I think it's also making sure that there's a straightforward document retention policy in your company that's actually followed in practice, because where those refund claims are there, you will need to effectively have that documentary evidence to back it up.
Yeah.
So I think for SMEs the main danger isn't necessarily the complexity of the situation, but it is the delay and the lack of procedure in place. The businesses that act clearly and early usually have a lot more options than those that are acting towards the end of the deadline and trying to do things urgently.
You don't want the cardboard box with a pile of receipts in,
Yeah,
do you?
exactly.
That's what you.
Exactly.
But actually, it's good practice, isn't it? This as much as anything, and the reminder in this, as a directive, I think that's something important to point out. Can I ask you a few kind of quite broad questions, Raymond? What this change means for companies in real practical terms, and how prepared you think businesses in the UAE are at the moment? Because it's not, keeping up with tax rules is important, but it's hard because it's complex, but it's a discipline, isn't it?
It's also, I mean, we have to remember that tax is a very new concept to the UAE for businesses, right? So, I mean, unlike other jurisdictions where company tax or VAT has been around for a very long time. I mean, VAT only came into effect in 2018, right?
Yeah.
Yeah. So we do have to kind of keep that in mind. But I think some companies are, but many aren't fully prepared, shall we say? I think your large multinationals or regulated firms, businesses with kind of a strong finance or those kind of functions are generally better positioned because they already operate within those kind of tighter controls. And they usually have more sort of mature record keeping strategies.
There's a history of procedures,
Exactly,
isn't there?
exactly. Yeah. Where I think is more vulnerable is among those businesses that have grown very quickly. Your startup that all of a sudden really picked up pace and is gone quite big, or those that have sort of relied heavily on external bookkeeping support, or they've treated tax compliance as sort of just a filing exercise rather than a corporate governance issue, if you will.
Yeah.
Right? Those businesses may have credit balances on the books, but no clear internal process on reviewing them, on claiming them, or how to just go about doing so, or preserving the underlying documents that support those claims. And this is more of a behavioral shift, I think, rather than a legal one or a business one, because the UAE tax regime is again, it's very young in comparison to virtually all other countries. Some businesses have they've kind of remained accustomed to a more informal approach, sort of pre-tax regime, if you will. But the direction of travel is very clearly toward a more mature enforcement environment, with clear deadlines, structured procedures, formal disclosures, greater ability for authorities to continue reviewing. So, whether it's tax, whether it's compliance, whether it's all of these kind of things, they're not really just side conversations or just sort of a tick box approach. They are really heart and soul of your business, even if they're boring, if it's not what you wanted to do, et cetera. So I would say that awareness is certainly increasing, but preparedness is very uneven depending on the size of the business, the maturity of it, and the awareness of it. I think many businesses are probably still underestimating how operational and how significant these changes are going to be to their day-to-day lives.
I get the feeling you make a very good point now. I mean, these amendments also revise how tax information is shared across government entities as well, and that's something you need to take into account. So it leads me to the natural next question. What are the risks if businesses aren't compliant with the updated rules?
Well, it's quite significant because, not only do you have the issue of you're affecting your cash flow, you're affecting your right to claim refund, because again, for the fifth time now, you are legitimately going to lose money and not have a right to it after that time period. But I think that there's additional risks that we can sort of split there. Again, the financial risk is quite obvious if you miss that refund deadline. But there's also a procedural risk there, where even where a claim is filed, if you have poor supporting documentation or weak internal records, that's going to significantly delay the process. It's going to prompt a lot of follow-up questions. And it's going to weaken your position to be able to claim. And you're effectively going to be wasting more time to try to chase that refund rather than going about your actual business. Right?
Yeah.
So there's that issue. There's also the issue of if you say a business files a refund claim late in the limitation cycle, that can expose the underlying tax period to a longer review, if you will. So if the records are incomplete, inconsistent, if they're not retained for additional required periods, that creates obvious issues for the business. And then I think lastly, kind of there's a broader corporate governance risk where weak tax processes can affect more than just the tax file itself. They can create board level concerns, lender concerns, due diligence issues if you're involved in an M&A transaction, for example, and just complications if there's disputes or you're trying to attract investors. Having those kind of sloppy records or non-existent records is going to significantly delay every aspect of your business. So the risk isn't only about penalties or the assessments, but it's about your cash, your credibility, your control of your company.
You mentioned it's a young tax is young in this country, in this jurisdiction, and you're right. It's a nascent industry, isn't it? And one of the things is, I think, keeping up to date with the changes as it grows as a system. So there's another side to this as well, that you need to, I guess, anticipate that there will be more updates. There are going to be more clarifications to the rules, probably in the not too distant future as well. And I suppose that's something that you, on a day-to-day basis, have to recognize.
Yeah, and I think it's trying to understand that nothing is sort of standing still. It's a living document, if you will. It's a living
it's set in
beast,
stone,
right?
but it also changes.
Yeah,
doesn't
exactly.
it?
So I mean, things will change depending on the need to change, on how the system is working or not working. So it is a kind of a trying to keep up with the times and trying to make sure that you are on top of it. And the more sort of clean house you have, the better organized that you will be, and it will just allow you to conduct the actual business that you're in, rather than having to sit there doing all this additional admin, if you will.
Yeah, that's right. Get it off out of your head, off your shoulders.
Exactly.
That's the thing, isn't it? I suppose that's one of the benefits of if you are keeping up to date with things. Something I wonder is, do you see the changes in the tax code from the authorities as a way of possibly as a stricter enforcement measure? Because there's an element of that, isn't there? You see a tax change, you think, better get that done, and how is that going to be enforced? As much as it is updating to keep up with the times, as you put it,
Yeah, I mean, again, and it's more of a broader system than again, just like we sort of said at the top of it is that this shouldn't be looked at as something happening in isolation or in a vacuum. It's kind of a part of a broader ecosystem, if you will.
Yeah.
Right. So the tax system is evolving, and it's evolving very quickly. So I mean, these amendments themselves are part of a broader legislative development, if you will, that began with the changes that took effect only in January, right? So the legislation is expressly contemplating sort of a more formal, official and binding directions around the application of tax legislation, which would suggest that a framework is being designed to be supplemented by practical guidance over the course of time. So I would expect businesses to continue, watching for further FTA guidelines, clarifications, and additional operational details on how these rules are to be administered in practice, especially around those kind of key issues to a business, such as refunds and audit procedures. So it's best not to wait for every possible clarification before you act. It's businesses that already know enough to strengthen their internal processes now, and get things in order, because there's no harm in getting your documentations in order. There's no harm in being able to digitalize your ledgers, etc.
Yeah. It's one of life's certainties, isn't it? Tax.
Exactly.
One of the two, apparently. That's how the quote goes. So, strengthen internal processes to stay compliant. Be aware of the changes. But for those companies who are potentially more affected by the workload, for example, by what's expected, the SMEs, what should SMEs and owners prioritize right now to avoid any issues down the road?
Yeah, again, I mean, it's especially the case for SMEs, but really for any business. And I think obviously, like your multinationals or those companies that are already regulated by financial regulators tend to be a bit better at this, because they're already kind of
There's a little bit more
built
preparation.
into it, right?
Yeah, for sure. Yeah.
But yeah, certainly, getting your house in order in terms of, who is dedicated within your company to deal with these filings, with document support. Who has taken courses? Who has kept up to speed with what the legislation is? How are you keeping this internal documentation going? How are you keeping track of your refunds, your deadlines, your filings? All of those things are really going to play a role because while you are running an SME, worrying about the 10,000 different things that you need to worry about to run that business, be it a coffee shop or whatever it may be, you've still got to keep up with these tax rule changes and making sure that your documents are in order to be able to not miss deadlines and not miss filings and to not open yourself up for exposure unnecessarily.
Sure. Know what you need to know, and if you don't know what you need to know, talk to an expert. I know one or two experts actually.
Possibly.
Yeah, there are a few around. Not looking in any particular direction at the moment, of course. Look, last question for you. We're a little bit over time, but I think it's important to run through this as much as possible. Certainly in broad detail, to zero in needs a little bit more time. But if you're a business owner and you're listening to this or watching this, you've got a credit balance on file, for example, what's the first thing that business owner should be doing to stay on the right side of this update?
Yeah, it's a big one because I think you really need to pay attention to a lot of different things. If you've got kind of historic credit balances or overpayments, those are going to directly affect your refund timing rules, right? Businesses that have complex or high volume transaction flows are going to be significantly affected because this would include businesses such as, for example, trading businesses, large distributors, logistic heavy businesses, where there's kind of frequent adjustments, cross charges, etc. That complexity tends to create credit balances irrespective, and you end up having a real documentation heavy burden there, right? And there's groups that undergo restructuring or rapid expansion. They have a real risk always of the tax treatment itself and sort of there being kind of a lack of continuity of records. And again, we kind of touched on this, but SMEs tend to sort of fall into that trap mostly because they are sort of big enough where tax is an issue, but they are not that big that they can be able to have, a dedicated accounting team and a dedicated. So they're kind of stuck between a rock and a hard place almost. Is that system? But yeah,
it's daunting for sure. You can understand that. That is the fine print for another week. Find this and other editions on your favorite podcast platform. And as ever, our legal expert is Raymond Kisswany. He is a partner at Davidson Co. And I thank you for coming in.
Thanks very much.
Appreciate it. This is Mira Business FM.